Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Charles Nenner, head of Charles Nenner Research, the firm that bears his name. Charles, thanks very much for coming on the show.
You're welcome.
Now, I know you were formerly at Goldman Sachs. You were an analyst over there. You went off. You started your research company. And you have a very kind of unique analytical perspective. I think you utilize a lot of sort of cycles or, I guess, human emotion, sentiment, market psychology, investor psychology, and what you do. So let's start off with that. Why don't we break it down now? Looking out, it's the beginning of 2014, a new year. Let's look at the major markets, what you see in terms of your work. Go right down the list. We'll look at metals, oil, stocks, bonds, the economy. So why don't you take it from there?
Well, the economy I kind of like, maybe surprising. I think it's going to pick up this year.
Pick up from where it is right now.
Yeah, it's going to be pretty stable, which will bring interest rates higher, but not very high. It's not that you will have a spike now starting interest rates going up.
Now, when you talk about interest rates, are you saying that the Fed is going to hike rates, or are you predicting a little bit higher rate on the long end?
On the long end.
On the long
end.
Okay.
And people are afraid that it's going to be bad for the stock market.
So on a 10-year, which is roughly around 3% now, what do you?
Well,
where
first
do you
of all, I think the maximum for a long time is going to be 4%. 4%. But it's going to take a long time to get there.
Okay. All right.
And the tapering issue is interesting because the European Central Bank is doing that already for 1.5 years.
Right.
And the stock market just continues to go up.
Right.
So I think the same thing once it's doing it here. I think we have the same direction.
Yeah, and we saw actually in the when they announced the taper at last month's meeting in December, we had a huge rally in the stock market. So it was almost one of these buy the rumor, sell the news sort of phenomenon. Okay, so a better economy, or at least an economy as strong as we're seeing it now. We printed a 4% GDP. So what does that say? That should be positive for commodities and raw materials, right?
Well, first of all, I want to say something about the stock market. I think the companies are going to have good results, but I think it's already in the price.
Okay. I
think the PE is going to expand, and that's the only way to get higher from here.
Okay.
And I'm looking still for this disinflationary, maybe deflationary period.
Deflationary period?
Yeah, I'm saying it all the time, starting in Europe.
Okay.
If this euro doesn't come down, they have to do something, otherwise they're getting into the deflation over there. But all in all, if you look to the values, the market is not as overvalued as people think. Okay.
Yet you're saying that it's priced in, all the very rosy earnings expectations. So I guess what you're saying is, it's going to get a little bit more speculative, the market, as opposed to reflecting the true value. What about gold? Now, a lot of people talking about gold. I ask people about gold here on this show because, gold has been disappointing in the last couple of years. And a lot of people who looked at it as a hedge against, what they were claiming as money printing by the central banks and all the monetary operations, quantitative easing, and it was supposed to create a lot of inflation. It never panned out. And it's come down quite a bit. What's your outlook there?
There are some misunderstandings. You have to look into history, like for Roosevelt did a bit the same thing. And in the end, I think that they paid only 8 cents back on the dollar.
Well, Roosevelt, he made it illegal for Americans to own gold.
Right.
Right, and he fixed the...
But I think by the inflation, all this money printing will stabilize. I don't think it's such a big thing.
So where do you see it going?
Well, the gold we got out at 1900.
Okay.
And
you're getting back in?
Well, almost. The different things that you have to watch. You have to watch the money supply in the world. You have to watch the interest rates. You have to watch the dollar. You have to watch if emerging markets want to buy or don't want to buy. And in the end, if you do all the analysis of the last 100 years, then it's actually only the dollar that has a big influence on gold. Now, as we do cycle work. That means it's not that out of the blue something goes up or down. our system can predict when the period is when something goes up and down.
So what about the dollar? I mean, the year has started off fairly strong for the dollar. It's enjoying a rally against most currencies. Do you see that continuing over the course of this year?
Well, it has been very stable, actually, on most currencies. I still see that it's going to stay very stable. I don't really like the commodity currencies.
Mm-hmm. So what, Australian dollar, Canada, New Zealand?
Soon, but not right now.
Right.
Right now. The emerging markets is not the place I want to be so much, so that's why I'm not so crazy about these currencies also. The fact is, are they going to have a synchronizing economy? That means Europe, US, and also emerging markets and Far East are going to pick up all together. Then we have a very good time, and I think it's possible that that's going to happen. Again, the big problem is that the disinflation will not turn into deflation. That's a big scare all the time, and people still seem to forget about that.
How accurate are these, sort of cycles in their ability to predict or forecast? I mean, it's kind of like when I look at these things a lot of times, in hindsight, you say, oh, wow, that lined up beautifully. But it's almost like a curve-fitting process. It looks like there's a pattern there, but really there's not. I mean, how accurate are they?
If you look at what was sent out on Sunday, you can always ask for a subscription. You get it for free just to check it out yourself. Then we will give you every day of a top of a high, major top or small top or high in the future. I would say it works 99% of the time.
99% of the time?
Yeah. And if it doesn't work, I always say, I made a mistake. The system didn't make a mistake.
So you got out of gold at 1900. You're not looking to get back in right now. You think it's going to...
We're playing a little bit for what we say people who yes, some people can't hold themselves back. They have to do something. The two kinds of investors who want to make money,
a lot of
investors
people
who
just
want
like
to do
the
something.
action, exactly.
Right.
It's not, they think they're after the money, but it's really the action that motivates them.
So we play a $10, $20 move, but the real long-term entry point is going to be in March, April.
So the 1900 where you sold or where you told your subscribers to sell, that wasn't a long-term top as far as
well, it depends what you make a definition for long-term top. I mean, the interesting thing is, I will tell you, at 1900 I give a sell signal, and people say, where do you think it's going? I says, in the end, I think it's going to 2700. Always stay in. But then it's 1800, okay, 1700, 1600, 1500, they get worried, and 1400 they start selling out.
Yeah. So
it's always difficult to say what's a long-term and short-term top, because everybody's there.
Well, the last nominal high, the cyclical high in 1980, that lasted 20 years.
Yeah.
So I mean, that's pretty long term. Anyway, let's quickly talk about oil.
I just want to say something about gold, because most people don't know that. The production of gold, there's some discussions about it. I would say it's around 800, 900. And usually gold is being traded with a premium of 85%.
Mm-hmm.
Right now it has a premium of 75%. In the 90s, it had the premium only of 45%, and that would correspond with the price of $1,000 right now.
A premium to what? The cost of production?
Yes.
Okay.
So you still have to know those numbers.
So you're saying 800, 900 is the cost of production?
Yes.
Is the average cost globally?
Yeah.
I mean, it varies. It could be as high as 1,400. It could be much lower.
700. But that's about where it is. But if you had in the 90s, you had only a premium.
So 80% on top of that, you're talking about 1,400. We're below that right now.
Right. When I said but, I want to say in the 90s, it only had a premium over the cost of 45%, which would bring it now down to $1,000. So fundamentally, there's also some reason to still be careful.
Yeah, I still see it potentially going to 850, where that old high was in 1980. But let's quickly just hit on oil. What's your outlook for oil?
Oil, we were negative. We were short. I don't remember if we're still short or not. And in a couple of weeks, we'll have a cycle low. And then we expect the oil price to go up.
For how long?
I'm not prepared.
You gotta.
I can't keep everything in my head.
As it unfolds,
no, but I know it's a weekly cycle, so that usually take a couple of months.
All right, Charles Nenner. Thank you very much for coming on the show. Appreciate it.
You're welcome.
That's it for now, folks. This is Mike Norman saying, see you next time. Bye bye.